Later today, Treasury Secretary Janet Yellen will testify before a House committee. She's expected to address inflation again, and it comes ahead of Friday's CPI data. Joining us now, Elyse Ausenbaugh, global investment strategist at JPMorgan Private Bank. I'm glad it says global there, Elyse, because we find out more and more each day that this really is a global concern. Interesting comments today from David Malpass at the World Bank, warning that inflation is going to be persistent, and so is slow growth, and actually with a list of countries around the world that are very, very vulnerable to entering into a recession with inflation, which makes us think the 70s and stagflation. Why should we not be really concerned?
I think the biggest thing to look at is the fact that core inflation is starting to show a lot of signs of coming down. We're seeing that shift from goods to services spending. We're seeing signs of labor market cooling, but the X factor here is obviously going to be what's happening with food and energy prices. But that's something that central banks understand that they can't entirely control. So heading into Friday with this CPI print that we're set to get, we do expect to see some moderation in that core figure, just as the consensus is expecting. But there is this possibility that the headline figure, including food and energy, continues to stay stubbornly high. Overall, directly answering your question about whether we get recession with elevated inflation, that stagflationary scenario is something that we still assign a very low probability to. But certainly acknowledge that recession risks overall are elevated.
It makes me sympathetic to Jay Powell's position, because the blunt instrument that the Fed has may not work against energy and food. It has nothing to do necessarily with economic activity. So they've got to kill economic activity with higher rates, and that doesn't mean you fix the supply-demand dynamics of food and energy. So the risk of a policy mistake is there. They could say, look, it's food and energy, so I'm not going to try to put a cap on that by raising rates too much. And if they don't do that, they've already done it. They've sort of been behind the curve. So the risk of a policy mistake is real.
Well, I do think that reaction function is a really interesting conversation to have right now, because if the core figure does come down, there is a chance that we do end up seeing that dovish pivot from the Fed, unless long-term inflation expectations do start to become unanchored by those higher commodity price pressures. Markets got that gasp of hope last week when OPEC came out and said that they wanted to expand their production capacity, or rather their production quotas. But the concern here is that they're not going to be able to deliver on those higher targets. We know that a lot of producers are already pretty much operating at full capacity. And so I think people need to manage their expectations and just kind of accept that oil prices are likely to stay elevated from here. We've got all of the different swirling dynamics going on with agricultural commodities that could continue to place those upward pressures on food prices. But for investors, I still think that Fed policy is the number one thing we have to focus on in terms of markets. But of course, that is continuously evolving into what it's going to mean for the growth outlook, depending on how much pressure they have to continue to apply via interest rates.